Hello and welcome to Business Standard's morning show. I am Ruchika Chitravanshi and let us take a look at the headlines for today. After 2 years of painstaking preparation, the government on Sunday finally approached SEBI to sell 5% stake in Life Insurance Corporation through initial public offering. It expects to collect close to 60,000 crore rupees through this move, a sum which will help the government meet its disinvestment target and bridge its fiscal deficit, which is widening due to an increased infrastructure push. Our next report tells us more about the IPO of the country's largest insurer and also if it is the right time to go public.
Dubbed as the country's Aramco moment, the initial public offering of Life Insurance Corporation of India has moved a step closer to reality after the insurer filed its draft papers with SEBI on Monday. The issue is set to dwarf the record $2.4 billion IPO of Paytm last year. Created by the merger and nationalization of 245 Indian and foreign insurers and provident societies in 1956, LIC has been a household name in India for decades now. Here are the key things you should know about the impending IPO. LIC is India's biggest life insurer with 286 million policies, 115,000 employees, 1.34 million individual agents, and more than 2,000 branches. It has a 64.1% market share in terms of premium and a 66.2% market share in terms of new business premium. It manages $528 billion of assets, which is more than the total size of India's mutual fund industry and 3.3 times more than the total assets under management of all 23 private life insurance companies. At about $130 billion, LIC's investments in listed equity represents around 4% of total market capitalization of NSE. The government, which owns 100% of LIC, is selling 316 million shares, representing 5% of its equity stake through the IPO. The issue is a 100% offer for sale, meaning LIC will not receive any proceeds from it. 10% of the IPO size is reserved for policyholders, while employee quota has been capped at 5%. LIC's dominance is unparalleled globally, with no other life insurance player in any country enjoying such a high market share. LIC is ranked 5th globally in terms of life insurance premium and 10th in terms of total assets. It is the only Indian player among the top global insurers. The draft prospectus has put LIC's embedded value at $71.3 billion. The embedded value is a measure of future cash flows in life insurance companies and a key financial metric for insurers. SBI Life Insurance, HDFC Life Insurance, and ICICI Prudential Life Insurance are the only listed life insurance companies in India. HDFC Life has a market cap of $15.6 billion, 4 times its embedded value, while SBI Life and ICICI Prudential Life have a market cap to embedded value ratio of 3.3 times and 2.4 times respectively. If LIC is valued at 4 times its embedded value, its market cap could be $285 billion, making it India's most valuable company. A 5% stake at that valuation will fetch the government $14.25 billion. If ICICI Prudential Life's multiple is taken, LIC could be valued at $171.1 billion. That would make it India's 3rd biggest company by market capitalization and fetch the government nearly $8.6 billion in the IPO. LIC reported a profit after tax of $199 million for the first 6 months of FY22. It collected premiums worth $24.6 billion during this period. Its gross and net non-performing asset ratios in the debt portfolio stand at 6.57% and 0.05% respectively. LIC faces significant competition from private players. As a result, it has been losing market share, although it continues to be the largest life insurer. The gross written premiums for LIC increased by 6.3% in FY21, compared with 24% for SBI Life and 18% for HDFC Life. With the government raising the FDI limit in insurance sector to 74% from 49% last year, there is an impending threat of foreign players entering the market and capturing market share. LIC's policies are primarily distributed through agents. In FY21, individual agents were responsible for 93.8% of new business premium, compared to less than 30% for its private peers. LIC said it may be required to take certain actions to facilitate the government's economic or policy objectives, and there can be no assurance that such actions would necessarily be beneficial to the company. Further, LIC is involved in approximately 26,919 criminal, consumer, civil proceedings, tax proceedings, and actions taken by statutory or regulatory authorities. The IPO filing has come at a time when a sell-off has gripped the Indian markets. The benchmark Nifty 50 index is down almost 10% from record highs set in October 2021 after falling 3% on Monday. The current IPO record holder Paytm is trading 60% below its issue price. To drum up market participation amid tough conditions for an IPO of its size, LIC has embarked on an advertising blitz to encourage policyholders to open demat accounts. While the IPO will be seen as a test of investors' appetite, the government is banking on the insurer's brand value as it hopes that the market will absorb the mega issue.
Another promising IPO may also hit the primary market soon. Though not as huge as LIC, the IPO of business-to-business e-commerce platform Udaan has all the potential to impress investors. In conversation with Business Standard's Nivedita Mukherjee, Udaan's co-founder and its newly appointed CEO, Vaibhav Gupta, tells us more about his firm's IPO plans and how was the union budget for the startup universe.
Hello, Mr. Gupta. Welcome to the show. I'll begin by asking you about the budget. Any takeaways from the budget? Anything for the startup universe?
I think it's a good budget. It feels it's a very growth-oriented budget, and it looks at some of the fundamental investments we need to do in our overall economy as well as the digital economy. So I think very excited about the forward-looking, very, very growth-oriented budget we have.
Udaan is headed for an IPO. You've made an announcement also. Last year, you said that in 18 to 24 months, you'll be going for an IPO. So what's the preparation like? Is it likely to come in 2023, calendar 2023?
I think as I said, we definitely see IPO as an important milestone. And we definitely are kind of seeing the timeline ballpark in the 18 to 24 month horizon for us. Udaan's journey started as kind of really defining Kirana e-commerce as a category of e-commerce in this country, right? And I think over the last 4 or 5 quarters, we have sort of started work on our consistent progress on our unit economics, which is also a good pathway to our our IPO plan. So I'm quite happy about the progress we're making both on the growth side as well as on the unit economic side, and a lot of work on rigor side in the company to actually prepare for IPO.
You mentioned performance. So by performance, do you look at profitability also? How does profitability fit in your scheme of things?
See, if you look at what Udaan has been trying to do in this country, right? Udaan is fundamentally was architected around mass market e-commerce, right? And if you look at India, there is an affluent India, and there is this next 500, 600 million or a billion India, which is kind of the mass market, right? And our belief from very early days of Udaan has been that you need a fundamentally different operating model of e-commerce to actually crack this market, right? If you look across, right, you can see a DMart versus Shopper Stop. You just need a very different, or you look at Jet Airways versus Indigo. In India, to really crack mass market, you actually need a very, 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 very different operating model, right? And I think Udaan has really pioneered that around the pivoting points of Kirana in this country, right? To how do you leverage Kirana, which is really the channel by which mass market actually consumes, right? How do you leverage them to actually build the right model around this. And Udaan has pioneered that, and there has always been this question in Indian e-commerce, Indian mass market e-commerce or grocery e-commerce is how do you crack scale and unit economics both? So to me, performance actually is on both sides for Udaan, which is how do we keep showing a growth in our sort of penetrating this mass market e-commerce, and how do we ensure that we are able to drive the right unit economics? Like if you look at Udaan, we reach out to almost 3 million Kiranas, retailer, shopkeepers in this country. Imagine all of them are 3 million forward deployed fulfillment centers.
I was looking at the numbers, more than 2,400 crore worth of losses. That was FY21, right? So your losses are down, but you're still in losses. Revenues are up. But are you looking at a break even anytime soon?
First milestone for us, Nivedita, for a platform like ours is fundamentally around unit economics, right? We want to make sure that, as we are growing, right, we are sort of solving for unit economics. And now Udaan has actually solved for unit economics, right? That's definitely one of the most important milestone for us over the last 2 quarters. We have sort of worked on that, right? And I think now for a lot of our focus would be to drive growth via maintaining unit economics, right? Which actually over a period of time for a market opportunity where Udaan is fundamentally a long-term compounding opportunity, right? Growing 35-40% year over year for long periods, right? Now for us, next part of our journey is how do we drive growth and profitability together to actually drive the EBITDA profitability. I think now to me, it will be balancing our investment versus at speed at which the market is opening up, right? And I think we'll have to navigate that path around.
What is the valuation of Udaan right now?
I think, as you would know, right, we are a private market company, right, and we definitely do not disclose our valuation in a public environment. If I look at last 24 months as a company, we have made material progress in our core fundamentals, right? We used to, over the last 2 years, our number of monthly buyers, right, have grown by 60%. Our monthly repeat rates of buyers have grown by almost 2,000 basis points, about 20% over the last 18, 24 months, right? And we have gotten much stronger on brand relationship, right? Across the country, across the categories, now top brands, mid-scale brands are all having direct relationship with Udaan, banking partners for our lending business, right? So I think a tremendous progress we have made around overall quality and the reach and the profitability of the business, right?
Thank you so much for speaking to us.
After the IPOs and primary market, let us move on to the secondary market. Sensex tanked over 1,700 points on Monday amid global sell-off. Foreign institutional investors, or FIIs, are the backbone of Indian equity markets. Over the past few months, they have been on a selling spree across most emerging markets, including India. What's making them nervous, and will this trend reverse? The next report takes a dive into how FIIs are viewing India as an investment destination amid rising headwinds. Foreign institutional investors have been on a selling spree across most emerging markets, including India. They have sold Indian equities worth over $7 billion thus far in 2022 and over $11 billion since October 21, when they started to unwind positions here. According to analysts, the nervousness right now is more on account of the likely policy actions of global central banks, especially the US Federal Reserve, that has seen hiking rates aggressively in the backdrop of 3-decade high consumer price inflation in the US. This, they believe, can see the bond yields spike and make equities less attractive. According to Devang Mehta, head of equity advisory at Centrum Wealth, FIIs have sold equities since October 2021. What's worrying them is a long tenure of zero interest rates across the developed world that seems to be nearing an end. Any balance sheet contraction by the US Fed, either in terms of quantum or timing, can be a further hindrance. High oil prices are another cause of concern for our economy. Let us now go to Anirudh Sarkar, Chief Investment Officer at Quest Investment Advisors, to understand what is worrying our foreign counterparts.
If you look at the relation between FI flows into India and the index movements, I think there's a very, very strong correlation between FI flows and how the index behaves in India. Historically, a few $1 billion of FI outflows in a single month used to impact the markets in a very, very significant way. However, if you look at the last couple of years, I think things have changed a lot, and the domestic investors have started playing a very, very strong balancing act to the FI outflows. And that's the reason we have seen the impact on the indexes very, very minimal, even considering the fact that we have seen one of the highest FI outflows from India over the last 1 year. Talking about the numbers, I think in this financial year as we stand, except for the month of September, almost every month since the beginning of April 2021, FIs have been net sellers in the Indian equity markets. In the secondary market, FIs have been net sellers to the tune of around 1.8 lakh crore in this financial year. And if I take into account the net inflows of the FIs into the primary market, even then the net figure for the FI selling is very, very high in this financial year. Talking about the main reasons and concerns, what is bothering the FIs and why they have been selling in such numbers. The first on the mind is definitely the whole interest rate parity, which is something which influences the decision towards investing into emerging markets like India, wherein the risk-reward picture comes into play. With US Feds increasing the policy hikes, with increasing the policy rates, I think it's very clear that we have an interest rate hike all around the corner, and the announcements have been made that in the month of March, we are going to see the first hike after so many years in the US markets. Apart from the US Fed hike, I think the other thing which is concerning the market is, or the FIs rather, is about the impending elections in some of the major states, and most importantly in UP. And this is something which is again keeping the investor sentiments on the edge.
The S&P BSE Sensex and the Nifty 50 have lost around 3% each since October 2021 when the FII started to sell, data show. Realty, fast-moving consumer goods and healthcare indices have been the worst performers among sectors indices that have slipped 7% to 11% during this period. Domestic institutional investors and mutual funds, on the other hand, have used this opportunity to buy. Since October 2021, MFs and DIIs lapped up stocks worth nearly 68,000 crore rupees and 94,000 crore rupees respectively. Going forward, analysts say FIIs may choose to remain on the sidelines for now and come back in a big way in the later part of 2022. India is expected to receive a good share of flows once volatility subsides. Domestic flows from retail investors, HNI's family offices still remain strong and have provided a good cushion to the markets when FIIs intensify their selling. A good probability of earnings growth along with a decent valuation re-rating can compel FIIs to come back with force. Devang Mehta, Head of Equity Advisory, Centrum Wealth, says. FIIs, according to Jitendra Gohil, Head of India Equity Research at Credit Suisse Wealth Management, still look at India as a structural growth story despite the near-term headwinds. The selling pressure should ease a bit in the coming months as the economic activities gain momentum once the Omicron-related disruptions abate and corporate earnings catch up to justify India's premium valuation. Jitendra Gohil, Head of Indian Equity Research, Credit Suisse Wealth Management, says. The sentiment on Tuesday is expected to remain cautious with nervousness around the rising oil prices taking center stage. That apart, market participants will take cues from global markets before deciding their trading strategies. Stock-specific movement is likely to continue as companies announce their December 2021 quarter earnings. After primary and secondary market, let us turn to entertainment. Ajay Devgan on Monday stirred a debate by saying that actors' move towards OTT platform was more about finding the right subject rather than the pandemic. Our next report tells us more about OTT platforms and regulations that govern it.
OTT or over-the-top platforms are services that offer viewers access to movies, TV shows and other media directly through the internet, bypassing cable or satellite systems. OTT services can be accessed through internet-connected devices like computers, smartphones, set-top boxes and smart TVs. In India's regulatory parlance, OTT platforms are called publishers of online curated content. Online curated content is audiovisual content such as films, web series, podcasts, etc., made available to viewers on demand, including but not limited through subscription by OTT platforms. On demand means a system where a user is enabled to access at a time chosen by them any content in electronic form which is transmitted over a computer resource and is selected by the user. Popular video on demand services in India include Disney Plus Hotstar, Amazon Prime Video, Sony Live, etc. In February last year, the government had notified the Information Technology, Intermediary Guidelines and Digital Media Ethics Code Rules 2021 to regulate OTT platforms. The rules establish a soft-touch self-regulatory architecture with a code of ethics and 3-tier grievance redressal mechanism for OTT platforms. They provide for self-classification of the content without any involvement of the Central Board of Film Certification. General principles require the platforms to not publish any content which is prohibited under any law and take into consideration the implications and exercise due caution and discretion in respect of the content which affects the sovereignty and integrity of India. They should also take into consideration India's multiracial and multi-religious context and exercise due caution and discretion when featuring the activities, beliefs, practices or views of any racial or religious group. OTT platforms must display age-based consent rating and content descriptor for each content. If applicable, they should also display an advisory on viewer discretion at the beginning of the program. The content should be self-classified into 5 age-based categories as shown here. In addition to this, the rules mandate a 3-tier institutional mechanism for handling public grievances. These are: every publisher should appoint a grievance officer based in India for receiving and redressing grievances in 15 days. Also, every publisher needs to become a member of a self-regulating body. Such a body will have to register with the Ministry of Information and Broadcasting and address grievances that have not been resolved by the publisher within 15 days. The Ministry of Information and Broadcasting and the Interdepartmental Committee formed by the Ministry constitute the 3rd-tier oversight mechanism.
Interestingly, male audiences of OTT increased twofold as compared to women during pandemic, a study has revealed. That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.